Hello, and welcome to episode 37 of the Wealth Amplifier podcast. Today, in what has become an annual tradition, I am joined by my father, Sam Liebman, for our annual Father's Day podcast episode. Dad, Sam Liebman, welcome to the podcast.
Welcome back from Aspen, Matt. How was that conference?
The conference was very good. It was our annual advisor to CEO conference that our friends at Dynasty Financial Partners put on this year, even though it was in Aspen. The professors that were there were from the Northwestern Kellogg School of Business, and they were, not surprisingly, quite good. And it was a long way to travel, beautiful town, but a good program.
Very good. Okay, sounds productive.
Yes, and so as last year you were the first two-time guest on the Wealth Amplifier podcast, now you're the first three-time guest. We're recording this on the Friday before Father's Day. We'll probably release the episode after Father's Day. But what we thought we would do a little differently this year is in the past two times we did this, you shared some of your we went down memory lane. You shared some of your history, some of your insights, perspectives from a long career, but we've done that already. Last year, we talked a little bit more about the future, but we've done that already. So if we've done past and future, this year we're going to focus on present. So what I thought I'd do is throw out a few topics related to the markets, the industry, the world, and just get your quick thoughts on them, and we'll just have a conversation around that. Sound good?
Very good. All right, I'm ready.
All right, let's start off with your favorite topic, the markets. So this year, we're now sitting here on June 13th, and more or less, the US stock market is more or less flat on the year, up a little, down a little, depending on the index. But in between, we had a major sell off and then a major recovery. So what do you think of all that? Are we roughly where we should be? Was the sell-off justified? The recovery justified? What do you think of the stock market in the US year to date?
Interesting and broad topic. It's a bit higher than I would think it ought to be based on my experience since 1970 in the markets. This market seems to want to believe positive outcomes on unknown. The statistics show that more people are now invested in the stock market, bond market, whatever, but mostly the stock market than ever. The percentage of Americans through retirement plans or personal accounts or however they're in it are in the market. A lot of them came up during COVID when there was not much else to do and they started speculating in the market. They seem to have learned the buy the dip philosophy, which they did again this time successfully, probably beating the smart guy pros in doing that. But the multiple, the PE ratio is in the low 20s. Historically, it's more like 16, 17. And with yields on the bonds, the long bond up to close to 5%, it is a bit rich. Now, having said that, the political situation, to say the least, is volatile. However, U.S. business is functioning better than ever. The balance sheets are stronger than ever. So maybe my previous views of markets that weren't so gosh, golly, and gee as this are misplaced because U.S. business has never been better, and maybe it should be selling at a higher multiple, which only leads me to keep the same analysis tools at work and to maintain the discipline and then stay in even when it's not comfortable.
Right. And it is interesting. You mentioned the whole buy the dip, and the individual investor seems to have learned that lesson really well over the last few years. And to your point, that takes a degree of optimism to do, or, at least some degree of optimism about the future. What's interesting about that is when you look at society, politics, et cetera, there's a whole lot of pessimism out there in the country right now, but it doesn't seem to apply to stock market investors who, as you said, seem to want to take this market higher and are looking through a lot of uncertain news.
Yes, it's not we have ups and downs, we have sideways and ups. Fine.
Yep, yep. Other than that brief period during the tariff tantrum, which yet to be fully resolved. But let's shift away from the U.S. stock market. One thing we have seen this year, which has not happened in quite some time, is the non-U.S. markets. The foreign markets have been outperforming the U.S. stock market. That more or less, other than a few pockets here and there, has not gone on for over a decade. How sustainable do you think that is? Or is this, do you think, and obviously nobody's crystal ball is perfect, but do you think this is another head fake where the US will take the lead again? Or are the foreign markets finally going to experience their long overdue mean reversion?
We had a period, I believe it was the early or mid 80s, in which foreign markets way outperformed the US and their currencies appreciated versus the dollar. So that the total return during that period of time was terrific. Now, it's probably 15 years now of outperformance of the US market to the foreign markets. They are cheap relative to our market. However, the question is how cheap? Should they sell at half the PE ratio of our market? I don't know the answer to that. However, their businesses and their business climate in general is not nearly as good as ours at this point. Now, you and I grew up in markets in which the statistical business that, reversion to the mean and regression analysis work. So the foreign markets are certainly due to outperform the US. And they are up, what, 15 or more percent when we're about flat this year so far. Part of that is that Europe is going on expansionary spending spree with defense, which is probably good for us and good for them also. And that's why there's hope along those lines. Now, there's no doubt that we are the Yankees and they are the A's. The question is, should we win every game and they lose every game? Probably you're going to have some convergence on the, back into the US. And that's why we have raised our relative allocations of foreign developed and emerging markets.
No, you're right. It is. I think the Yankees and A's. While you're more a baseball guy than I, it's an easy metaphor to understand. And the U.S. is certainly best of breed in terms of business fundamentals. But we've been trading maybe like we're best of breed times two recently or something. So maybe there is some sustainability to this foreign rally. Last public market asset that I wanted to talk to you about. You've been a long believer, as we've talked about in past podcasts, that the foundation for the stock market is the bond market or interest rates. And interest rates right now, after there was a lot of hype that they were going to go down precipitously this year, and then a lot of hype that they were going to go up through the roof, they're more or less where they were 6 months ago, sort of in the low fours, low to mid fours of the 10 year. What do you make of the interest rate market right now? And how do you view bonds in general?
Wary about going out farther on the yield curve by buying intermediate or long term bonds. Prefer most likely to stay short and to try to make profits through the stock market rather than the bond market. You get a profit, of course, in the bond market when you buy long term bonds and yields go down. However, we have deficits which are tremendous, which look like they're going to get bigger. It's harder and harder to finance the interest expense on the debt alone is going to be one of the highest things in the whole budget of the discretionary side. And I would not go long term. To me, that's a negative. That's something to be, let's say, to take into consideration before you get too bullish. Apparently, the individual investor public does not care about that at this point. Now, I know today, so Israel attacked the nuclear facilities and various other places and people in Iran overnight. The markets were down. The stock market was down, let's say, around 1.5 to 2% in general, and the European markets were down also, and so forth. Yet I noticed that usually when you get something that creates fear or concern or panic or whatever it is, there people run the gold and they run the dollar, and they also used to run the U.S. Treasury. U.S. Treasuries were down fairly sharply today,
Yep.
even though you would think that people would be running to Treasuries for safety. Certainly, they were selling stocks. So where did the money go? It didn't go to bonds. So I would be afraid of intermediate and long-term bonds because of the debt and deficit and the interest expense of the whole bit. And today's move, in which yields went up maybe 7 basis points at a time when they should have gone down 7 basis points based on a traditional flight to safety, is that the only thing that did go was gold up, because the dollar was up and gold was up anyway. And since gold is denominated in dollars, that is really a double move versus anybody in any other currency on gold. But those were the only two things. Stocks and bonds both went down. There's a theory put out that bonds are the ballast. Me being an ex Coast Guard guy, ballast is supposed to keep the ship from foundering. Right. Well, today they were not ballast. They increased the loss. They didn't go counter to the loss. So bonds and stocks were down today, which is what they did my first 13 years in the market from 69 to 72 to 82.
Yep, and it's also what they did in 2022, which was a pretty
Yeah.
ugly year for markets. Yeah, no, I think in general, to me, I very much agree. We've talked about this. It's not so much that I think rates need to go way higher, and that's why I wouldn't buy long-term bonds right now. It's more that if I'm getting roughly the same yield, close enough, not exactly the same yield, but close to the same yield on a short-term bond, who needs the risk of the long-term bond? You'd need a probably either a major slowdown in inflation and or a recession to get those low rates a lot lower, and that's a risk that I don't really necessarily feel the need to bet on when I can get, roughly speaking, 4% on short-term bonds anyway.
No question about it. In normal times, if you do go into a recession, you get lower interest rates. But you got to ask yourself, which lower interest rates? The Federal Reserve in a recession, I'm almost sure, despite Powell versus Trump and vice versa, would lower rates. But that does not necessarily mean that loan rates can go down also when you have to finance tremendous deficits. So that could screw up the whole business cycle. Whereas, you have across the board rates go down in a recession, the economy recovers. Well, what happens if it's only the short rates to go down and the long rates don't, because of the tremendous deficits and interest rates and all that? So that's another reason to stay away from anything other than pretty close, not even intermediate, certainly not long term, but not even.
Yeah, short, intermediate, et cetera. So I guess last topic, we'll shift away from the public markets and move to the hottest area in our industry, in the investment industry, I should say. And it's getting all the attention, all the articles, and we can't avoid having someone email us, call us, show up at the office with a new pitch for a new private investment, whether it's private equity or private credit being the one that's getting the most attention recently. And the Wall Street Journal recently wrote an article about this growing trend as well. So you've seen a lot of growing trends over the years, and they haven't all worked out that well. What do you make of this move towards private investments? Is it something to embrace, something to be worried about, or maybe just evaluate with a degree of skepticism?
Well, it's certainly the latter. Evaluate with a degree of skepticism. So I grew up in a lot of negative markets, which were not just skeptical on events as opposed to this market. They were sort of cynical about anything. Yeah, it looks good, but it's probably bad. Anyway, everybody wants to issue private debt and equity mostly, and to individual investors, and they want to lower the standards by which you buy them. In other words, private investment's been around for years. Question is, if trying to offer them to the mass investing public, they used to have standards that indicated a certain amount of sophistication, a certain amount of net worth, and so forth. I don't think those standards should be lower. And usually, when you see everybody trying to go after these things, that we have been offered I don't know how many, thousand, a million, whatever, over the years of those type things. We have done some very rarely, and after a lot of analysis, and we've had very good success with the ones that we have done. But I don't know if that's 1 in 25 or 1 in 100 that we've been offered. And now they're offering many more of these to supposedly a broader population of investors. That can be fine, but usually it does not end well.
I agree, and I think that's why I sort of teed up the question that way, and I am in your camp of I don't think it's necessarily something to be terrified of, but more something to be skeptical of and do your analysis. I think so. Unlike there have been some hot trends in the markets over the years that have led to major blowups, systemic risk. Look, could that happen? Sure, but I'm not sure it's going to get that bad. I think it's more and this is the way we view it. Private equity, private credit is just another way of owning bonds and stocks. It's less liquid. Maybe it's in a less correlated area of the market. Maybe there's some more long term upside. Maybe there's some leverage, but there's also a little more risk, so on and so forth. I think where people get into trouble is because these markets or these investments don't mark to the market or price every minute, every second, every day like the public markets do. There is, I think, a false sense of security in them. What some people, I think Cliff Asness, the major portfolio manager, has referred to as volatility washing. That essentially they dampen the volatility and it makes people feel like they are safer than they are. We don't view them as good, bad, or otherwise, other than an investment that needs to be evaluated. And as you said, if we think they're ones that make sense for our portfolios and our clients' portfolios, we'll take a close look. But I don't think you need to buy everything that comes across our desk like it's like it's the best thing since sliced bread because it rarely is.
Yeah, you have to wonder why over the years there's always been alternative investments, private investments, so forth, with very high barriers to entry. So why now all of a sudden this altruistic desire of Wall Street and the investment banking to offer their best private alternative investments to the individual investor? Maybe they are that nice now. I don't know.
So, having been on many sides of this business, I think I can posit a guess at that one. Number one, they especially in the credit markets, some of the banks have walked away from that market, particularly after the Silicon Valley Bank, Signature Bank, that mini banking crisis we had about a year and a half ago. And so some of these private credit funds are filling in the gap. But I think the bigger issue, to your point, of why now are they actively going after the high net worth and even more mass affluent markets? And I think it's to a large degree they've saturated the institutional markets. There's less growth opportunity there because they already have a lot of that market. So they're looking for their new pot of money. And as you said, it could be great, but appropriate to be skeptical.
No question about it. By the way, I think it's the Harvard endowment, which is gigantic. I think it's the biggest one of all the universities, and has a very high percentage in the private deals, alternative investments, debt, equity, and so forth. I think based on something I've gleaned from the news lately, they may not be having so much liquidity to invest in that area anymore. Hence, the need to replace with other investors.
No, that's right. That's right. And that's why there's been this little bit of this boom, and we won't go into it on this podcast, in these what are essentially called secondaries funds, but funds that are essentially trying to provide some liquidity to those investors in private equity that need some liquidity. But we promise our listeners we keep these episodes to about 20 to 30 minutes. So we'll wrap it up there. Sam Liebman, Dad, happy Father's Day. Thanks for joining the podcast, and we'll see you this weekend.
Yes.